We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it. If the cause of it is the perception of the deterioration in the purchasing power of the US dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the US dollar.
In the current environment marked by persistent inflationary pressures and mounting fiscal imbalances, silver is attracting renewed attention as a critical component of diversified investment portfolios. While gold has historically been regarded as the primary refuge during economic uncertainty, silver's distinctive qualities, as both a precious metal and an industrial commodity, position it uniquely for significant upside potential. Legendary investor Rick Rule draws on decades of experience to highlight striking parallels between today's economic conditions and those of the 1970s, a decade that saw silver prices escalate dramatically from $1.30 to nearly $50 per ounce. This historical precedent serves as a compelling framework for understanding silver's role not only as a hedge against currency debasement, but also as a vehicle for meaningful capital appreciation. Rule emphasizes that silver typically follows gold's initial surge in investor interest, then often outperforms due to its lower price point, greater volatility, and robust industrial demand. He recalls the remarkable performance of silver producers like Silver Standard and Pan American Silver in the 1990s and early 2000s, which experienced share price increases from below $1 to upwards of $45 within a relatively short period. These outcomes illustrate silver's potential to generate outsized returns when macroeconomic forces align with market sentiment. Given the current backdrop of unprecedented federal debt and unfunded liabilities, Rule projects a substantial erosion of the US dollar's purchasing power over the next decade, citing Congressional Budget Office data that estimates a 75% decline, similar to that which occurred in the 1970s. In this scenario, he anticipates gold prices could quadruple, with silver poised to achieve even greater gains owing to its unique market dynamics. Beyond its monetary appeal, silver's role as a critical industrial metal further bolsters its investment case. The growing demand from sectors such as renewable energy, electric vehicles, and advanced electronics underscores silver's increasing relevance in a modern economy undergoing technological transformation. For Rule, now in his 70s but as engaged as ever, the opportunity silver presents is not merely speculative, but rooted in historical cycles and fundamental economic shifts. He views silver as a rare asset capable of delivering asymmetric returns in an increasingly uncertain financial landscape. For investors seeking to protect purchasing power while capitalizing on growth, silver emerges as a compelling and timely strategic allocation for the decade ahead. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
A confession, whenever I criticize speculators at a conference like this, if Bonnie, my wife, is present, she starts laughing and she says, by the way, all the money that Rick invests conservatively, he made speculating wildly. So, yes, I have a fondness for it. I've participated in 3 precious metals bull markets in my life. This will be the 4th. And at some point in time, and I'm never smart enough to say why, you probably are actually, given your competence in technical analysis as an example. At some point in time, the generalist investor comes down into the precious metals market, having been attracted by gold's momentum. And then perhaps because of its unit cost, silver takes over the leadership. And when it does, as you know, it's truly, truly, truly dramatic. And although I don't need to make more money, I want to make more money. I really, truly enjoy the game. I'm 72 years old, and I want to experience that sort of quantum escalation at least one more time in my career, and silver gives it to me. When I came into business, I'm older than you, as you know. When I came into business in the 1970s, I witnessed an amazing silver market. The stuff went from $1.30 in 1970 to $50 in 1981. One stock that I was aware of, but I was too dumb and too poor to buy it, was Coeur d'Alene. It went from 10 cents, this is not a typo, 10 cents in 1970 to $65 in 1981. And that stuck, you know, that stuck in a young man's mind. But I didn't participate. But as I think you know, in the later part of the 80s, the early part of the 90s, which was a spectacular silver market that people forget, I was involved in Silver Standard, which we took from 72-cent financing with a full warrant, thank you, to 6 years later, $45. And Pan American Silver from 50 cents, Ross Beatty was too cheap to give me a warrant, to $45. Those two moves, from below $1 to $45 in 6 years, stuck with me and have stuck with me forever. We are, I believe, coming into a precious metals bull market that will resemble the best of the prior markets. And if past is prologue, that same performance, I'm not saying $1.30 to $50, don't get me wrong, but that same sort of relative outperformance, silver to gold, and then silver stocks to silver, I think we'll see in this market, and I'd like to play it.
Okay.
I believe that the analog to the deterioration of the purchasing power of the U.S. dollar that we're going to experience is the 1970s. In the 1970s, according to the Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power. This is not some old fat libertarian, Rick Rule, saying this. This is the office, the Congressional Budget Office. I believe that because of the accumulated debt and deficit, particularly off-balance sheet debt, entitlements, and the unfunded entitlement liabilities, that the purchasing power of the U.S. dollar over the next 10 years is going to decline by 75% again. I don't know how it'll be reflected in the gold price, but the easiest thing for me to say arithmetically is that the increase in the gold price will mirror the deterioration of the purchasing power of the U.S. dollar. If that is more or less right, then the gold price goes up fourfold from here. People say to me, Rick, like, give your head a shake. Gold has already gone. It's already up 40%. If the analog is the decade of the 70s, let's assume that the move in gold price from $35 to $100 was a dead cat bounce off the restriction of the gold price. And let's say that the move in the gold price above 550 to 850 was morons piling on. That move from 100 to 600, six-fold move, is a pretty good move. And if the cause of it is the perception of the deterioration in the purchasing power of the U.S. dollar, I think it's absolutely right to assume that the increase in the gold price, the increase in the nominal gold price, could reflect the deterioration in the purchasing power of the U.S. dollar. I'm not, because I was surprised that gold hadn't moved further, faster, earlier. My belief, and Trey, you and I have discussed this over dinner, my belief is that gold does well when people are concerned about the maintenance of their purchasing power in U.S. dollars. I've been concerned about that for a very long time. The arithmetic that concerns me is not expressed by the CPI, which I don't think is a good index. So I've been surprised by the muted response of gold hitherto. I didn't know, as you know, because we talked about it, when gold was going to move. But it seemed to me like an inevitability. As you and I both have talked about, I have a flaw in that I often confuse the words imminent with inevitable. But no, I haven't been surprised at all. I think it's way overstated. When I talk about the deterioration in the purchasing power of the gold, I'm talking about in an absolute sense, not in a relative sense. I think relative to other currencies, gold will do well. Franz Pick said there's a lot of ruin left in a country this great. Ruefully, I agree with that. I believe that gold will be the world's reserve currency for the balance of my life. For the record, I'm a healthy 72-year-old. But I think its hegemony will reduce. When I look at
the dollar's hegemony.
Yes, it'll be reduced. I think the U.S. government is doing their best to destroy the U.S. Treasury as a savings instrument, politicizing it, debasing it. But what are the alternatives? Our friend, Doug Casey, once said the dollar is an I owe you nothing, but the euro is a who owes you nothing. And I mean, the other analogy is the prettiest mare at the slaughterhouse. I'm not concerned about the dollar relative to other mediums of exchange. I'm worried about the dollar as a storehouse of my own wealth. I personally, Trey, I'm telling this to your audience, you know this, I personally save in gold. I personally maintain liquidity in dollars. Those are two different statements.
Gold prices have soared to unprecedented heights, recently reaching the $3,400 per ounce milestone amid a perfect storm of market dynamics. This remarkable rally reflects more than just a numerical milestone. It signals a fundamental shift in investor sentiment and macroeconomic conditions that warrant careful analysis. The precious metals ascent is driven by a complex interplay of factors, including escalating geopolitical tensions and evolving monetary policy expectations, creating what analysts describe as a textbook environment for gold appreciation. Investor anxiety, fueled by unresolved US-EU trade negotiations and a looming deadline, has intensified demand for traditional safe haven assets. Historical data underscores gold's resilience during times of uncertainty, as seen in the 2008 financial crisis and the US-China trade tensions of 2018 and 2019. Alongside gold's surge, Rick highlights that silver has also garnered increased attention as a complementary precious metal. Although silver is often more volatile, its dual role as both a monetary asset and an industrial metal means it benefits from similar macroeconomic trends that support gold. The growing demand for safe haven assets amid economic uncertainty extends to silver, which frequently experiences heightened interest during precious metals bull markets. Furthermore, the potential shift toward more accommodative Federal Reserve policies aimed at preserving growth amid concerns about inflation creates a supportive backdrop for both metals. While gold leads as the primary store of value, silver's distinct characteristics and lower price point make it an important part of the current precious metals landscape, appealing to investors seeking diversification and exposure to inflation hedging. Let's get back to the video.
It was motivated by a negative real interest rate.
Okay.
We fought. Well, you didn't. Well, you were alive then. We fought the war in Vietnam, which we lost, and we fought the war on poverty, which we lost. And the highest marginal tax rate in the United States then, before weird deductions, was 80%. So we couldn't raise taxes. We had to deal with these social obligations. We did it not by changing the nominal value of our obligations, but really by changing the purchasing power of the dollar. The second thing that happened is that the way that the fear of inflation was expressed in the market, or put differently, the experience that consumers had with inflation juxtaposed to the rate that they got on their savings meant that interest rates were sharply negative. We had a 10% measured rate of inflation. We measured it, of course, differently then, and people were getting paid 5.5% on their savings accounts. Well, that was reflected pretty clearly by a change in asset allocation from cash and cash equivalents or long-term bonds to gold. We have a circumstance today, Trey, where if your listeners believe in the CPI, they're pretty sanguine. You get a 4.5% yield in the U.S. 10-year Treasury. In a currency where your purchasing power is deteriorating by 2.5%, you're getting a 200 basis point real yield. I believe that's ridiculous. The CPI is not a good measure of the deterioration of the purchasing power of your savings. For one thing, the CPI doesn't include tax. Do you pay tax, Trey?
A little bit.
Yeah. If you look back at the basket of goods and services that the Reich family consumes, say, I don't want to test your memory and go too far back, but 2020 to today, gasoline prices, up 2.5% compounded? Hardly. Mortgage rates, doubled. Groceries are a political issue, up 60%. And they're telling you that the deterioration of the purchasing power of the U.S. dollar is happening at the rate of 2.5% a year? I mean, what they're smoking is not legal to transport state to state to state. What happened to me in 2010? Now, I didn't catch the top. I never do. But there were other circumstances where stuff appeared to be much cheaper. The consequence of that is that I made the swap. I do consider gold to be a form of liquidity because I've proven to myself over 40 years that when the time comes, I'm not psychologically indisposed to selling it. One of the things I do, which I think your audience might find of interest, is that beginning in the year 2000, that was a momentous time, and I had a discussion with myself. Where did I want to go? What did I want to do? One of the things that I began to do was to keep an informal alternative ledger in gold. My net worth, my income, my expenses in gold, rather than in the US dollar. And for that part of my ledger, when I look at what things cost today, I wish I'd been all in gold. Some stuff like rooms at this hotel, or a Big Mac, or a car, are really cheap. If you measure them in dollars, they're anything but cheap. But understanding that the dollar-gold exchange ratio was $250 to an ounce of gold at that point in time, if you equalize the numerator and the denominator, if you measure your savings in gold, you're struck by the deterioration of the purchasing power of the U.S. dollar, and you're surprised by the steady reduction in the actual price of many goods and services on a global basis if you're valuing them in a constant. It's a really interesting consciousness-raising exercise.
If gold is what you perceive as a cash equivalent and saving, how would you position gold equities in a portfolio or in a life?
Gold for me is insurance and savings. Gold stocks are investments. I don't own gold to make money. I own gold to maintain liquidity and maintain my purchasing power. I'm good at buying gold stocks. I've worked at it for 50 years. It's my craft. That's different. Owning gold stocks is one of the ways that I increase my store of gold. But they're different businesses. Gold doesn't require any work. Just like a life insurance policy doesn't require any work other than paying the premiums. So I regard them as very, very, very different asset classes. In a different part of my life, in addition to being an investor in gold mining companies, I'm a speculator in the juniors. And relative to other people, I'm actually a better speculator than I am an investor. I'm willing to do the work. I have 50 years of mistakes, but there are three different buckets: insurance, investment, speculation.
And that speculation bucket, I think you would always recommend people have a very, very long time frame, correct?
Yes, and be willing to do the work. The more speculative the entity, the more psychological tolerance that you have to have for perturbation, and the more willingness you have to work. I have, as I think you know, Trey, graded tens of thousands of investor portfolios for free over the years. I ask people to submit them to me. I grade them for free. I've taught a lot, and I've learned a lot. And I ask investors to limit the number of speculations that they have in their portfolio to the number of hours per month they're willing to work on their speculations. Not got a hunch, bet a bunch. Read the quarterly filing statements, read the proxy statement, read the resource statement, read the insider filing statement. If you are willing to work 10 hours a month, by 10 hours a month, by the way, I don't necessarily just mean listening to podcasts, but rather reading filing statements, doing something like that, then you could own 10 stocks. But many of the portfolios that I've graded have had 65 or 70 stocks, and some of the stocks are unpronounceable to the holders. That's not good.
Silver is exhibiting strong bullish momentum as it consolidates just below the crucial resistance level of $39.12 following a vigorous rally. After reaching an intraday high near $38.94, the metal experienced a minor pullback, which appears to be short-term profit-taking rather than a reversal, as key support levels remain intact. Support around $38.41, reinforced by the 50-day and 100-day exponential moving averages at $38.36 and $38, respectively, provides a solid foundation for further upside movement. A clear and sustained breakout above the $39.12 resistance level would likely accelerate the bullish trend, opening the door to near-term targets at $39.47 and $39.78, with the potential for even higher gains as long as market sentiment remains positive. Given the current macroeconomic environment marked by inflationary pressures and continued investor appetite for precious metals, silver is well positioned to extend its rally, making it an attractive asset for investors seeking to capitalize on its upward trajectory in the coming weeks. Share your thoughts on Rick's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.